Thank you all so much for joining us. So with my dear continent, Africa, FDI into the region has flatlined and in some cases actually fallen over the last decade or so. And amid this funding squeeze, we're going to have a conversation about the potential for African-based institutions to provide some long-term sustainable financing in local currencies to support these projects, how we think about risk and risk perception. We're going to get into all the nice financial jargon. Warren, I want to start with you. Thank you for being here. You wrote recently that additional investments of $2.4 trillion will be required until 2030 to meet Africa's climate needs, but only 12% of that has been committed so far. Why do you think that investors are still so hesitant when it comes to really banking on projects in the continent?
Firstly, thanks a lot for having me. It's great to be here. I think the figure you mentioned is correct in terms of climate financing. And I think you heard a lot of the speakers talk about some of the challenges specifically with climate financing. However, when we look at the data, we see that the problem is much broader. If you look at total assets under management in Africa, it's actually less than that 2.4 trillion. So in the next 6 years, if all the assets we have today goes purely into climate, it doesn't actually fill the gap. So we need to look more broadly. It's not just about how do you make climate financing more attractive in Africa, but how do you make investments more attractive? And at least from our discussions with investors, with LPs, what we find is kind of three kind of big reasons. The first is around liquidity, the lack of liquidity in the market. This is a bit of a kind of a network effect of having people to actually sell onto. The risk return reward. So you heard it from our previous speaker as well. The data that we see is over the last 10 to 20 years, net IRRs for private funds in Africa around high single digits versus around 15%, let's say in the US. So why would you put $1 here versus there when lower risk? And part of that is exasperated by the macro climate and currency associated with that. So I think lots of real challenges, not insurmountable, but I think it explains a lot for why capital goes elsewhere.
And Chinua, let me come to you next. There is capital on the continent that could be unlocked and put to better use, put to more productive use. What are some of the pools of local currency capital on the continent that we could be considering for the funding of these critical projects? And what more can we be doing to unlock them and tap into those?
Thank you. It's a pleasure to be here. So if I could provide some context, I mean, AFDB estimates that our local pension funds, our insurance companies, asset managers, and sovereign wealth funds in Africa hold a combined about $2 trillion in assets under management. And there is a unique opportunity to mobilize these domestic resources for development. InfraCredit was established to address that market failure in Nigeria. In 2017, we were set up by a combination of the Sovereign Wealth Fund and international DFIs to de-risk projects, infrastructure projects, and attract our domestic pension funds to actually provide long-term finance in local currency. And this is particularly important because we've experienced, obviously, devaluations across Africa in the past few years. We all earn, in Africa, many of us earn our income in local currency, so we pay for these tariffs in local currency. So when you borrow in dollars and you have a devaluation, that is an issue of sustainability in financing. And so today, definitely there are instruments that can de-risk these assets. And actually, one of the interesting things you find with guarantees and credit enhancements is that it helps to bridge the gap between what is considered as perception of risk versus actual risk. Because what it does provide over time is that it provides that data that investors can look at over time. I mean, in the past 7 years of InfraCredit supporting over 18 projects across over 9 sectors, indexed to the dollar in local currency, about $450 million. We've had 0 defaults in our portfolio. Even the Moody's report that, on infrastructure project bonds in Africa estimates that Africa has one of the lowest risks, credit risk when it comes, default rates when it comes to, project finance. And so we pay a high premium for perception of risk. And I think, the ability to use local financing demonstrates the resilience of local assets, especially those that are providing essential services. And, when you estimate the amount of financing, for example, that the World Bank, in Africa, so we have, 600 million people that don't have energy access. And it's estimated that, mini grids, solar mini grids, are least cost technology that can electrify most Africans over the next to 2030. And it's estimated that we need roughly somewhere around $217 billion or thereabout in order to, to enable these $127 billion to enable these mini grids to be built. Now, this financing can be sourced locally, right? And we have proven models, which we'll talk about in the course of this session, where we've been able to de-risk, green finance in local currency, attract local pension insurance companies to co-lend on a blended basis alongside DFIs or development partners that are able to bring concessional finance. So I believe that these instruments do exist, and as we look inwardly into the resources we have and how we can be able to use innovative tools to mobilize this financing, we stand a great chance of addressing these market failures.
I think you've touched on something very important there, the cost of risk perception. We were having a conversation earlier about how there are many projects that would seem less risky if sovereigns were willing to guarantee them, but that is expensive. And, InfraCredit was actually raised as one alternative way of guaranteeing some of these projects. So it's interesting that people are beginning to think about other financial instruments and other ways in which we can use the tools and the knowledge we have to, again, begin to close the gap between the perception of risk on the continent and what is actually really risky. And I want to come also to this question, because it's not all perceived risk. The challenge also with a lot of our currencies over in this side of the world, they are prone to devaluations and all kinds of other fluctuations. Some of that risk is real, and that does make investors skittish. Alexander, I want to ask what more African-based institutions could maybe be doing to change these perspectives, and also how might they help de-risk projects like yours with ACOB Lighting?
Thank you very much. I would say for us, as a micro utility company, we were very much privileged to see firsthand, first loss capital and the blended finance play out, and this was very well exemplified with about 1.5 billion, which we raised in the Q1 of this year through InfraCredit. So what has that actually done for us? As a catalyst, what that has done for us is that it has helped us, one, reducing FX risk. As you know, majority of the equipment that we import for these renewable energy microgrids are basically imported. So what has been happening? We've had a case whereby we've seen a blend of partial 50-50 funding coming from the DFIs in foreign currency, and our paybacks is actually basically in local currency. Which are the organizations that I see could be doing what InfraCredit is doing? I want to see more of NSIA doing a lot more in terms of that. For us, it's catalytic in the sense that we have gone through the rigors of raising private commercial funding. Today, the commercial lending rate in Nigeria is hovering around 35 to 41%. You would agree with me that that is not sustainable for any long-term infrastructure project. And what the market typically provides is a landscape opportunity. Presently, I know the World Bank is bringing in about $750 million on a DARES program, which is potentially unlocking, a more private investment of over $1 billion into that sector. So imagine having such a catalytic fund. What it will do for us is, one, it will reduce our risk in terms of thinking about hedging for offshore equipment that we're going to be bringing. Two, it will reduce the timelines through which we'll also close more on this financing. And I see it as a win-win, because for us, we are consistently building a portfolio that we can aggregate and keep building and scaling the deployment of electrification for unserved and underserved communities in Nigeria.
And Nazmira, I want to come to you. I mean, one of the kinds of worries, again, thinking about the investors who are feeling a little bit skittish, even though recovery rates in this part of the world are supposedly higher when it comes to infrastructure projects than elsewhere, those default rates initially are also higher. Tell me a little bit about what we know about the default rates of long-term infrastructure projects, how they compare with other emerging markets, and basically, are some of these fears substantiated? Also, just a reminder to the audience, please use Slido to send us lots of questions. Let's really grill these panelists.
I think you've seen, is this on?
Maybe give it like a second.
Yeah.
Good. There we go. I think a few of the speakers have already referred to the fact that default rates are not much higher in Africa than in other emerging markets. EMs as a whole are slightly higher than developed markets, but actually Africa is pretty much in line with the default rate of a lot of developed markets if you use the Moody's Project Finance database that's been referred to. So this goes back to 1983. It's principally private sector projects, because one of the criticisms of the GEMS database is this is MDB projects and they have special protection, whereas the Moody's database is private sector projects. So why do we think that is? Why is it that the default rate is actually pretty much in line with what you'd see in the developed world? Well, one of the reasons is I think only the best projects get done in Africa. There's such a perception of risk that so many projects just do not happen. And the projects that get done are, I would venture to say, overstructured in order to protect investors against the risks that they worry about. Some of them real and substantive, some of them more perception. And we see this. So, for example, the Emerging Africa Infrastructure Fund that we manage has had its mandate expanded into Southeast Asia 2 years ago. So this is a fund that's been operating across the continent, supporting private sector developers for 20 years, has about $1.5 billion lent out to private sector projects, about 70 of them in various places. More than half the book is in energy, and the bulk of that's increasingly renewable energy. But the type of protections we're used to getting in Africa are a whole lot more than we're able to get in Southeast Asia. So that's one of the issues on default. Then you talk about credit loss rates and inherent in that is the recovery, and the recovery rate's the same, because the general view is you go to an investor in any developed market part of the world and they think the African default rate is going to be higher, and when you get into default, you're going to get a whole lot less back. And actually, that's not the case. And our personal experience is that's not the case. So the fund that I referred to, been operating for 20 years, credit loss rate of 20 basis points a year. Average credit rating that looks like B minus. If you map the loss rate onto the Moody's actual loss rates and what the implied credit rating would be, triple B flat, triple B plus, 7-8 notch upgrade between the reality and the rating that's often capped by the country ceiling.
You know, it's interesting you say that. The more investors I speak to, especially the ones who have been around for a while, so the more experienced investors, will often say, if we were going based off of what the ratings agency said, we supposedly would have lost billions. And what they've lost in reality has actually been negligible. So it's always quite interesting to hear from people who are experienced in actually backing projects on the continent, and people who worry more so from afar. A question from the audience. There's a perception that there's a lack of bankable projects on the continent. How do you, and anyone can take this, maybe Warren, we could start with you.
Yeah, so.
Is that a fair perception when it comes to Africa? Is there a lack of bankable projects?
At least not in our experience. What we see is that, so we work with development organizations, we work with some philanthropics as well, and a key role that we think is missing is helping some of these projects get to investment readiness. What you find is that sometimes on kind of the grassroots level, you have very innovative, more technical people that are driving these projects that may not have the kind of ability to drive to tell the story in a broader way that will attract investors, and unable to kind of pull that whole kind of robust business case together. And actually, that is quite a key skill that we think is missing to help bring these projects to a level up. And then you then need to match those projects to the funding. We see that there's a lot of kind of intention to invest, And I think as Naz has mentioned, is that you can cherry pick in Africa, and therefore only the best get funding. And then there's a lot that just gets left behind. I don't think they don't exist. They're just not brought to the forefront.
And Chinu, I have a question for you. What more could governments and the states themselves be doing to attract this, encourage this, build the enabling environments that also might send the right signal to investors?
Well, thank you. Sometimes perception also becomes real. So the question around whether or not we have sufficient bankable projects, relatively, one would argue that it's real in a form. It's now a question of the bridging that asymmetry of information and what I consider as a knowledge exchange gap. That essentially means a lot more times what we've tried to do is to walk backwards, working closer with the developers to communicate what the lender's criteria is. Because a lot more times you have engineers building projects and not really taking into context what the lender wants. So essentially that gap is what creates the perception of not so good enough projects. But it requires a lot of work in terms of capacity building, knowledge exchange to bridge that gap. So there's a bit of working backwards to work closer with project development facilities. So the project preparation facilities that are set up could be coordinated in a better way so that they deliver projects that can get to financial. Now, with the governments, it's really ensuring that they are listening to investors, especially the local investors. Because a lot more times, you have to treat your local investors well, so your foreign investors will come. And understanding the pain points of local investors, essentially, stability in regulations, and just ensuring that the policies are stable enough to attract financing. There are very interesting ways that we've seen government de-risk projects by actually putting their capital to build out the projects and then recycle capital, sort of what we call asset recycling. So in some states like Lagos State, they actually invest in building out the rail line and then subsequently attract private sector partners. And those private sector partners can raise financing from the capital markets and they can recycle their equity back in. So that model helps to bring more projects across and provide demonstration effects that could be replicated.
Okay. Again, just encouraging more audience questions. They were great. We are grilling them. I want to also ask Alexander, obviously, with the projects that you have actually been able to carry out, give me a sense of how your relationships with your investors might also encourage other investors to come and similarly back projects on the continent.
So I would say just also aligning with what she rightly said, it takes a lot at that scale when you're looking at investors even coming in to invest in your projects. So for us, I would say the experience with the InfraCredit facility was more of a hand-holding experience, preparing us for the next phase of our investment raise. Because what did that do? Internally, in terms of our corporate governance structure, in terms of our attention to details, as well as getting these projects really structured in a manner that is investment ready, and also setting the right parameters. Because let me be honest with you, the right investment will always come when you have the right structures and framework in place. And what have we seen from our experience? So we've gone from raising seed investments and fundings from $50,000 to where we are currently, and on the DRIFT program, which we're looking about $15 million, and also hoping to scale up that. What we have seen from the rigors is the fact that at different scales and level, generally, the investors are out to look out for something very critical. Your processes is very key, your design, and most importantly, you must have to speak to the business model. So this hand-holding has helped us. And I believe, looking at scale and utility at that level, incorporating that, and more importantly, your corporate governance structure, that gives us an edge in positioning ourselves to be able to attract other more fundings as well.
So one criticism that I think has been whirling around, especially with these conversations of risk perception, is bias in the credit ratings agencies. It's a messy conversation. I'm trying not to go too deep, but an audience question just kind of prompted me. And maybe Nasamira, we'll start with you. What is your view on how an African credit ratings mechanism might help change perceptions of risk abroad?
I think I think that's a difficult question to answer, to be quite honest, because on the one hand, a ratings assessment that is better able to consider emerging market conditions broadly, not just African conditions, I think has use, because the benefit of the doubt given to a lot of the institutions in the developed world are increasingly being questioned currently. But the problem with developing a local rating agency is, what is the usefulness ultimately? If it's going to be used by local pension funds, then there's clear value. Local pension funds, local insurers. But if your local insurers are mainly subsidiaries of foreign multinationals who are ultimately regulated by the European regulators, they need to use one of the top three globally.
I could add a few points.
So it's about access to capital for me. And I think what we are better off doing is trying to engage more with the credit rating agencies. I want to give one quick example on where my frustrations with rating agencies come in. On a fund level, like if you try and get a fund rated, one of the big rating agencies, who will remain nameless, told us they wanted to work with blended finance. They wanted to do a whole lot more there. We're developing a structure that could be useful, and they have 20 people in the room initially. Let's talk about this. And then they come back eventually and said, no, they've decided their fund rating methodology cannot apply to any portfolio which has more than 5% outside developed markets. Like, why waste our time to start with? So that's where you're starting from.
Okay, Chinua.
Yeah, thank you. So data is very important, and performance data that is sort of evidence-based helps. So our experience has been, we've had situations where we do our internal credit rating, and then we also get an external rating on projects we provide credit enhancement for. We've had situations where downgrades have happened by the external rating agency, whilst we have not downgraded because of the information we have on the project. Now, over time, and we've seen several projects that in 5 years later, while the rating agency projected default, that asset did not default 5 years later. So that type of data helps to address this perception and actual risk. But more importantly, I think whether you have an African rating agency or not, you still need to address that gap, because either way, they're working with information made available to them and their perception of risk. So I think the more this data is provided from private actors and projects that are financed, the more it helps to address that perception of risk for the institutional investors themselves, so they can be more informed. We've had projects that we've guaranteed. They access finance with guarantees. They came back to the market, and the institutional investors, the pension funds, were willing to invest without a guarantee, because they got comfortable with the performance data from that company. So I think we have to work more in providing that evidence-based data that actually addresses what is considered, because usually guarantees don't address the loss given default. It actually addresses, the perception, as opposed to actually the probability of default, which is what drives ultimately the rating. So we would have to play around with the data to help address that issue.
A very important final word. Thank you so much. I think there would, as much as there is need for more information, there would also be more information if more projects are being financed. So we find ourselves in a bit of a catch-22. But thank you so much for joining us on this panel. Please give them a round of applause. That was incredibly insightful. Thank you so much.